in context of estate planning, alternative investments can create some friction in the conversation for a few different reasons. We can look at these in alternative investments and, privately held companies in there, because when looking to fund someone's estate plan, not all the time do they just have cash hanging around fund up to a federal limit, which now is pretty significant. It may change, which is part of the reason for the conversation, but you have only so many assets on your balance sheet. More often than not, you're looking at cash producing assets or an income that you will need to still continue to spend. So you have to look at other assets outside of there. And you can't put retirement plans into an irrevocable trust without creating a big taxable event. So typically not done. So what do you look to? Illiquid investments have long-term time horizons. Wow, that sounds like an alternative investment to me. So when properly funding an estate plan with alternative investments, which we do, have done, and will continue to do, you have to be cautious of valuation. You have to make sure the person filing your give tax return, whether it's the CPA and or the estate planning attorney, has confident information on how you got the value of that investment. That's one. Two, you need to understand the tax ramifications of this. So depending on the type of irrevocable trust that is set up, how is the taxation of that investment going to act? Is it going to be income oriented? Is it capital gain oriented? Is it a combination of both? Is it real estate? Do you get some depreciation? There's a lot of potential options in there. So you have to understand the tax ramifications, because if you look at total rate of return and don't consider the tax ramifications of the future growth, you got to be mindful of that. Then on top of it, when the tax obligation comes, do you have the liquidity to pay for it within that irrevocable trust, or do you have to designate money outside of that? And you have to plan for that in advance with A, the proper drafting of the trust, but B, just proper liquidity. Because if you put an alternative investment into an irrevocable trust and it grows and you pay some of the tax benefit out of an irrevocable trust, you are decreasing the benefit of what you just did. So if you don't have a proper plan around the asset and the tax obligation today and going forward, you can just decrease the benefit of some proper planning.